This week, the S&P 500 continued its rally with a 3% gain despite some extremely bad economic data. Hello and welcome back to the Wall Street Petting Zoo. This is our This Week at the Zoo segment in which we review the week's market news and offer predictions about the coming week. I'm Christopher Smith.
And I'm Robert Coburn. And this week, we started the week on Monday with a 1% drop after Morgan Stanley forecasted that U.S. coronavirus cases wouldn't peak until May, and the economy wouldn't begin to reopen until June. Carmaker stocks had an especially volatile day. Ford issued a first quarter revenue warning that sent shares of the stock plummeting, whereas Tesla soared on news that it had posted record sales in China for the month of March.
Yeah, and that's record sales in China in a month when car sales overall in China were down by 40%. So that's really, really good news for Tesla. So Tesla had a great week. Tuesday, the S&P 500 climbed another 3% despite some bearish signs, including an IMF forecast that we're headed for the worst depression since the 1930s, and also some pretty bad earnings results from big banks. JP Morgan missed earnings estimates by half, and Wells Fargo earned only 1 cent for the quarter compared to the 33 cents of earnings that analysts expected. JP Morgan also issued a revenue warning for the second quarter, forecasting that a lot of people are going to be defaulting on their credit card debt. And even as bank stocks plunged, the technology and healthcare sectors rallied. Roku reported that streaming hours doubled in the first quarter. Probably that won't be sustained, but at least during quarantines, they seem to be doing very well. And Johnson & Johnson raised its dividend despite slashing revenue forecasts for 2020. So those two sectors, technology and healthcare, did really, really well.
And Wednesday, the S&P 500 dipped a little over 2% because of a whole bunch of really negative economic data. Retail sales data, industrial production data, and capacity utilization data for March all came in quite a bit worse than analyst forecasts. And we also got some early manufacturing numbers for April that were much worse than expected. We also saw a bunch of corporate bankruptcies, including the publicly traded companies Frontier Communications, LSC Communications, and Hospec Offshore Services. Also at risk of bankruptcy are JCPenney, Intelsat, and Town Sports International Holdings. And then there were a bunch of negative economic forecasts, including predictions of a 15% downturn in home sales and clean energy employment. Credit rating agency Moody's forecasted that some job losses will be permanent, and unemployment will peak anywhere from 8 to 16%, and will only partially recover to about 6.5% by the end of the year. Honestly, I'm surprised the market only fell 2% on all this bad news.
Yeah, right now the official unemployment number is 4.5%. And we're already on track to be quite a bit worse than that because that doesn't include the latest job report in which we posted 5 million new jobs. And I think it doesn't include the previous one either, in which I think it was 6 million jobs the previous week. So, quite a few more jobless claims have been added since we had that 4.5% unemployment number. So we're already on track to be quite a bit worse than that. And 6.5% by the end of the year is a pretty bleak number, really. I think that a lot of investors are expecting the market to just pop back and all those jobs are going to come right back at the end of this. And we're probably going to find out that the economy is in a slump for a lot longer than that. The market did rally 0.5% on Thursday when we posted that 5.2 million jobless claims number for the week. So despite that being slightly worse than expected, we expected 5 million jobless claims and we got 5.2 million. So it was slightly worse than expected, but still the market rallied a little bit. There were also really negative signs from the oil market on Thursday. The oil cartel OPEC slashed its demand forecast for 2020 by another 7 million barrels per day. So that offsets almost the whole 10 million barrel production cut that OPEC committed to last week. So that's a huge reduction in demand. And the price of crude oil closed on Thursday below $20 per barrel, which is a very important technical support level. We have been holding above $20 per barrel for the most part. So to close below $20 per barrel was a really, really important breakdown of that support. U.S. shale oil producer Yuma Energy declared bankruptcy on Thursday, and industry analysts are predicting that there are probably a lot more U.S. shale oil bankruptcies coming. So that could really, really hurt some of those Midwest economies, the Dakotas. Some of those northern states, along the border with Canada, are going to be really hurt if there are major bankruptcies in shale oil. The CEO of Morgan Stanley also forecasted on Thursday that we are headed into a recession that will last through the end of 2021. And also on Thursday, the US government's Paycheck Protection Program to lend money to small businesses ran out of cash without any renewal from Congress. So overall, the news on Thursday was really pretty incredibly negative, and I'm surprised that the market closed the day up even 0.5%.
Yeah, and I also wanted to comment a little bit on the jobless claims, and you also mentioned how we may take a little bit will take a lot longer than analysts are expecting to get back to quote unquote normal, or at least we're back at the levels that investors were expecting. So not only are we not probably expecting all those jobs to come back right away. I expect there to be a huge bottleneck right when everyone, like the economy, quote unquote, reopens, with regular employment, because everything has to go through, like when people get background checks, those have to go through the courts. Now, I've already seen it firsthand with hiring right now, with the courts being closed. Background checks are taking a lot longer than they normally would, and now with the economy possibly reopening, there could be a huge bottleneck just in the background checks. So we may see a lot longer for just employment in general, and not just because the fact that the jobs are there, but just for the fact that just to get signed and working at a job may take a lot longer than what most people would expect.
Yeah, I think all of it is going to be rockier reopening than people think it will. I mean, if you think about like a manufacturing company that decides to reopen its factory, what if its suppliers in its supply chain haven't reopened yet? I mean, it has to get materials uh, from its suppliers in order to be able to run its manufacturing business. So there are going to be all sorts of bottlenecks, I think, for the economy to reopen.
Yeah. And so maybe the reason the market rallied Thursday was because investors were expecting the release of news that afternoon. After the market closed, the pharmaceutical company Gilead Sciences released some positive early trial data on using the drug remdesivir to treat coronavirus cases. Gilead said that nearly everyone treated with the drug was able to leave the hospital within a week after receiving treatment, and only 2 patients died out of a few hundred in the clinical trial. Also, Donald Trump declared Thursday afternoon that we're past the peak of coronavirus cases, and he wants to reopen parts of the country by May 1st. Stocks soared after market on this news. However, there was no randomization and no control group in the Gilead trial, so scientifically speaking, it's meaningless. And when you get into the details of Trump's plan to reopen the economy, I think May 1st is probably not realistic for most parts of the country.
Yeah, Gilead sort of threw a wet blanket on those leaked results and said, "Look, this is not clinical data. It hasn't been controlled. It hasn't been randomized yet. So, like, don't get too excited. It's purely anecdotal." And yeah, I think also analysts are looking at the Trump plan and going, "We're not sure that May 1st is really going to happen. It may be that we are not actually past the peak of coronavirus cases. We have just peaked in terms of testing." Because it looks like the growth of testing capacity has slowed down a little bit in the last week or so. So we're not 100% sure that we are actually past the peak of coronavirus cases. And Trump himself is tweeting that we need more testing in order to verify that we are, in fact, past the peak. So I think that we probably next week will see return of a little bit of pessimism, but we certainly opened higher on Friday. We pulled back a little bit Friday morning as crude oil prices crashed to the $18 per barrel range. So crude oil has continued its downtrend. But by the end of the day, the market did surge higher to close the day up over 2.5% for the day on Friday. So that news about potentially reopening the economy and also about positive results from the Gilead drug overall made investors more optimistic on Friday. And we did end the week above a key moving average. So the S&P 500 now has support at that moving average at 2811, and it has resistance at the next higher moving average at 2924. So in terms of technicals, I would expect to see a continuation of the rally early next week, that we might move up to that next moving average resistance. But in terms of fundamentals, I think everything is pointing downward from here. So maybe we will test that higher moving average at 29.24 or even at 29.58 before we fall again as more negative economic data rolls in later in the week. So, possibly a green open next week. We'll see, but I would expect later in the week to see the market turn a little bit more red as investors get maybe a little bit more realistic about the challenges ahead as we reopen the economy.
Yeah, on the other hand, I'm already seeing a lot of people questioning whether we're really past the peak of coronavirus cases, or if we just don't have enough testing capacity. If the epidemic worsens over the weekend, or we see another spike in new cases on Saturday or Sunday, then you can expect next week to start off in the red.
Yeah, we definitely could open red, I think, depending how the numbers look over the weekend. I think Friday, or I can't remember if it was Thursday or Friday, we posted a new record in terms of deaths, which tells me that even if the number of confirmed cases looks like we're past the peak, deaths is probably the real measure of where we are in terms of the epidemic. So for us to still be posting new records in terms of deaths tells me we may not actually be past the peak yet. We may just have peaked in terms of testing. All right, Robert, what stocks did you watch this week?
So last week I called out Dollar General and Dollar Tree. So both dollar stores ended the week much higher than the start of the week, although Dollar Tree wasn't really expected to perform as well as Dollar General. However, this week, the CEO of Dollar Tree came out and stated that although their supply chain is stressed, they have $1 billion in the pipeline, quote unquote, somewhere. So
$1 million of like financing?
No, $1 billion in their supply chain.
In their supply chain.
Yeah.
So they've got $1 billion of orders pending.
Well, coming into their stores. So they reported that basically they get a truck every couple of days to each store, and the supplies in those trucks last about a day and a half before the next truck comes in. So they're basically saying that as soon as stuff hits the shelves, it takes about 48 hours for most of that stuff to sell.
I see.
But the CEO, I found the verbiage that the CEO used to be quite funny, because they said they have $1 billion in the pipeline somewhere.
Yeah, it kind of seems like he doesn't really.
That's not really vocabulary that a CEO should be using when being interviewed.
It doesn't inspire confidence.
Yeah, it doesn't inspire confidence. But I mean, the stock did end up higher than the start of the week. A good, I think it was up $7 up to I forget the exact dollar amount, but it was up a good amount, about the same percentage as Dollar General. So they, as I expected, I didn't expect them to perform as well as Dollar General, but I'm not sure if it's just because they're in the same industry, but they both ended the week a lot higher than they started.
Yeah, discount stores do really well during recessions. I saw some data this week on groceries that showed that like purchases of groceries have increased like 20 some percent. So, consumer staples providers are certainly going to do well for as long as quarantines last. Also, we mentioned earlier that Johnson & Johnson jumped this week because it raised its dividend. Costco did the same thing. Costco also raised its dividend. So yeah, these the consumer staples companies are usually a nice safe haven during a recession, and I'd say they're sort of extra well positioned in this recession because of people stocking up, staying home. So I think that these, even if quarantines are listed, I think that these companies should continue to outperform in the near future because there are going to be fewer people going out just because they're scared. So probably restaurants will continue to have a weak year and possibly a weak few years, whereas grocery stores I would expect to have a couple of pretty strong years.
Yeah, remember how I called out Dave & Buster's earlier in 2019? I don't think they're going to do anything this year.
Yeah, they're in trouble. Retailers in general are in trouble. I saw some data this week on uh, who's paying their commercial mortgages, and it was like 10% of retailers are paying their mortgages
Yeah,
versus like 93% of homeowners. So we're already seeing huge signs of trouble in the retail market.
yeah. Which what stocks were you watching this week?
So last week I watched gold, and gold surged early in the week, but it fell on Friday, and so it about broke even for the week. It was up slightly, but not significantly. And I think that given where it is in terms of its technicals, I think it probably will continue downward early next week before bouncing late in the week from some of its moving averages. I also am still watching Frontline Limited, which is my favorite oil tanker stock. If oil prices continue to fall toward $15 per barrel, as they seem on track to do right now, Frontline should move up. So I am expecting next week that Frontline may test $10.50 to $11 per share. So that's sort of my target to take profit. And then I will buy the next dip after that just because Frontline has a really nice dividend. And I think it's actually worth holding for the long term. So those are the two that I watched. And this week, I will probably buy some oil if it hits $15 per barrel and some more if it hits $10. The instrument that I'm using to trade this is USL, which is a 12-month oils futures ETF. Oil is really hard to play because a lot of the funds that have exposure to oil have pretty high expense ratios associated with them. I was using USO, but the price decay on that is just huge. USL is not perfect, but it still has less decay than a lot of the other ones because it's using a 12-month futures contract rather than a 1-month futures contract. And it's complicated, so I won't get into the details. But basically, right now, the 12-month contract is a way better bet just because of what's called the contango curve. So you can go read about that online if you want. But yeah, USL is the one that I'm using to play oil right now. Basically, futures traders are anticipating that by the end of the year, we'll be back up in the $30 range. So, if oil hits $10, then that's like 200% upside from there. So definitely watching oil. I think that it has a lot of potential right now.
Yeah, and this week I'll be watching TPOR, which is Direxion Daily Transportation Bull. It's a ETF that's basically just transportation ETF. It's fairly cheap right now, as its holdings include like airlines, railroads, and delivery companies like FedEx and UPS. With the airlines getting bailed out, and then there's also some semblance of governments reopening, we will probably see a small jump in these stocks during the week, but it'll probably, go back down by the end of the week. I actually bought into these stocks, bought into this ETF when it was sub $5, and when it was at like $4.50, and this was like mid March, and I've just been holding on to it ever since, and it's already doubled my investment. But
That's fantastic.
but at the same time, I'm holding on to it long term because I'm expecting it. I'm probably going to hold on to this for about 1 to 2 years. I'm not looking to sell this tomorrow, but if you're looking to sell right away, I mean, this may jump like I said in the beginning of the week, but it's going to taper off and probably not stabilize until the airline industry is back on its feet in terms of full capacity planes, pilots aren't getting laid off. Right now FedEx and UPS are doing really well because everyone's having to like ship everything, but at the same time some of the transports like Caltrans and some of the other like passenger trains aren't doing as well, obviously, because people aren't traveling.
Yeah, FedEx got a boost, of course, when Amazon shut down its delivery service. So that has helped the shippers as well. But yeah, shippers generally, I think, are doing fairly well. But I think the airlines, some of the other transportation sectors have a long road to recovery ahead of them. One that I'm sort of extra bullish on this week is Southwest Airlines because Robert and I were talking before the podcast here that Southwest just announced that they will not be downsizing. whereas all of the other airlines have announced that they will downsize. Southwest is in a sufficiently strong position that they're going to be able to maintain their current size. So I think that Southwest will probably snatch up a lot of market share from some of the other airlines that are really struggling during this coronavirus recession. It's been interesting to watch this sector, Robert, because the losers are the companies that were sort of hardest hit by this downturn are also the ones that are getting the most government assistance. So in some ways, it has paid to invest in losers.
Yeah.
They've been the ones that have gotten the biggest rallies as a result of all the government assistance. So I sort of took the wrong strategy in my trading. I mean, I invested in cash-rich companies that have been really responsible and have a lot of hedges and everything. And all this government assistance basically has come in and really thrown a lot of money at the losers, and it's destroyed the hedges of some of the winners. So I think that, we talk about moral hazard, like the government intervention during all of this has really, really created a lot of moral hazard.
Yeah, I learned from the 2008, and I was like, airlines is the way to go because they always get bailed out. And even though they don't use the bailout money correctly, the government still likes them.
Yeah, yeah, we've definitely seen that. Well, but the losers though are taking on a lot of debt, and often they are taking a lot of debt at very high interest rates. I saw late this week that Ford is borrowing at 11% interest. So
Ford's always had problems with debt management to begin with. So,
yeah,
and their stock was already bad before. Like it was around like $7 last time I looked at it, and this was before all the pandemic. So when you said that the stock had tanked earlier this week, I can only imagine what that means for the stock without even looking at it.
yeah, I think it was at like $4 last I looked at it, but I haven't looked at it in a while.
Yeah,
But
for
they're
the
definitely struggling, and I expect them to have if they recover at all, I expect it'll be a long road recovery, because when you're paying 11% interest, you can't invest in your business when you're paying those kinds of borrowing costs.
yeah.
Yeah, I mean, they've gotten a lot of help, all these losers, but long term, when they're paying those kinds of interest rates and they're burdened with this much debt, I don't necessarily think that the recovery is going to continue for these companies that are in difficult situations right now. So we'll see. All right, Robert, got anything else to add before we sign off?
No, just continue staying safe out there, maintain that social distancing, and wash your hands.
Yeah, folks, if you heard anything useful on the podcast today, please give us a like, share on YouTube, on Facebook. You can follow us on Facebook or Twitter. We'd love if you would retweet our podcast at some of your followers, help get word out about the podcast. We don't do any advertising for this show, so it's purely word of mouth, and we really appreciate your guys' support. Also, if you would like to support the podcast in a financial way, we have a referral link to Webull underneath our video. We've talked before on the podcast about what a great trading platform Webull is. We both really like the platform and like the tools that it offers. And if you open up a Webull account using our referral link and deposit $100, you will get a free stock, and we also will get a free stock, and that helps support the podcast, helps us make more of these great videos and podcasts for you. Thanks so much, and we will see you back at the zoo next week.
See ya.